All right, here we go. Buckle up, Buttercup. The market has shifted, and that is what we are here to talk about today. So, we are going to get into where we're at, how things have changed over the last couple months, and where we potentially are headed. So, hang tight. Let's get into it. All right, so we're going to start off by looking at some data from Hillsborough County and Pinellas County. So, we've got a pretty large data set here. We're looking at average and median year-to-year date. So this is actually 2 years, but we're focusing on just the 1 year, year-over-year. Average is up. It's 20.4. Median is up 17.7. The new median home is 390, significantly up than what it was 2 years ago. So things from on the surface here look pretty good, but it's not really telling us the whole story. And the problem is that when you see the peak in June, we've started to see a decline. And so since June, we are down on the average 4.7 and down on the median 2.5. So that is a trend that we are expecting to continue to see. And there's a variety of reasons why, but one of the main driving factors is going to be inventory. So inventory a year ago was at 1.2, which is nothing. And now it's at 3, which honestly is still really low. And to give you some context for that, if you're in a seller's market, which is 6 months or less of inventory, we expect prices to climb. If we're in a buyer's market, which is 7 months or more, we expect prices to decline. So right now, at 3 months of supply, you're like, oh, well, it's still a seller's market. We still got plenty of wiggle room. But there is a tremendous shift in the terms of behavior that's happening right now, and has happened over the last 3-4 months. And a lot of that is driven by interest rates. But that behavior is allowing inventory to stack up while buyer demand or buyers are exiting the market as we speak. So you can see showings are way down year over year and active listings are on their way up. But to put things in context, when you look at year over year mortgage data, we've jumped a huge amount from in the mid 3s really to where we're at now. And I know this says 7.8 or 0.08 on the 30-year fixed, but realistically, you're probably looking at 7.25 to 7.5. And that's assuming you have a good credit score. And when I say a good credit score, I mean like 720 plus. That's the kind of rate you're looking at right now, which is mind-blowing as to what that does to your payment. Now, 7% interest rate all by itself, honestly, not that bad if you look at the larger context of history. Right here we have a graph that kind of shows all the way from the 70s through now. And yes, interest rates did used to be up into almost the 20s at one point. And most of this history, interest rates were well above 5 and into the 7s or 6s for a good portion of this history. And so to be at 7, it's not that big a deal. It's more the pace of time that we've gone from the beginning of this year. You could have bought something at 3.5 or 4, and now you're at 7.5. What that does to someone's payment is dramatic. And what I mean by that, to be more specific, is if you have, a guy who's looking at houses at, let's say, the average house around $400,000, that same house that he could have afforded at $400,000, now his budget will still only allow him to buy a house at $320 or less for that same kind of payment. And obviously, that house at $320 is not the same as the house at at 400 or 410 or whatever he might have been looking at. So that's a dramatic shift. So that's going to cause people to leave the market. And really, we don't expect interest rates to subside until we see some shifts in inflation, because mortgages and inflation kind of they don't live on islands by themselves. They really mimic each other in a lot of ways, similar to the 10-year bond. But mortgage rates were held low, and if you look at this chart, you can see that QE period, they were held low by the federal government. I'm not going to get into all the details of how they were doing that, but they were intentionally held low because we wanted to basically preserve the economy during this weird COVID time. But the minute they took their foot off of the gas per se, interest rates started to mimic inflation. And really, the rates that we're seeing now probably should have happened 6 months or a year ago in terms of these rate hikes. But it is what it is, and so now the federal government is going to look at short-term pain for long-term stability. And so until we start to see inflation get under control, it's very unlikely that we'll see mortgage rates come back down. Now, it's not all doom and gloom. This does provide a lot of different types of opportunities, and interest rates very likely will return to a little bit more normal or stable state at some point next year. And there's a lot of different projections as to like where we're going to land on mortgage rates. So, I mean, I hear some more negative Nancy type projections in the 9 or even 10% sometimes. These are different analysts, so nobody has a crystal ball. Nobody really knows where they're going to be at. I think I see more often than not a kind of a 7 to 5 range in terms of projections. And so I would say realistically, we're probably going to fall somewhere in that range. But whether that happens in the spring or summer or fall or winter, it's hard to say. So where does all this leave us? So where that leaves us now is we're redefining the market as we know it right now. This is the shift. We're in it right now. And we don't know exactly where we're headed. We've been in similar type scenarios, but COVID really changed the game in a lot of ways because it's had all these weird spin-off effects on supply chain and interest rates and all this stuff that we didn't expect, and now we have to deal with it. So I feel like because the market has been so high for such a long time, we are going to see a correction, and this is in a lot of ways a good thing, so we shouldn't look at it as this is doom and gloom. At the same time, we need to get real with the situation. And if you're a seller, I feel, as an analogy for you, I feel a lot like I'm the first guy in the roller coaster in the first car, and we're coming to the top of the hill and about to make our first descent, and the buyer's right behind me in the next car, and he can see it, but the seller's like 5 cars back, and he's like, nope, we're still headed up, we're good. And the reality is that it's not like it was in the spring. We're about to be on our way down if we're not already on our way down now. And so if we're going to make some changes and some shifts, it needs to happen now. So I would tell you, if you're a seller and you're thinking about selling, then you really need to get real about it and get real about your pricing and how you're going to market yourself and position yourself, because now you're going to have real competition. You're going to actually have to negotiate with buyers. It doesn't mean it's not a bad time to sell, because if you're thinking about selling in the next 12 months, we don't know where we're going to be in 12 months from now or 6 months from now. So I would tell you to sell right now and get it off your books. If you're a buyer, your appetite should start to get wet. Now, you need to understand there's going to be a lag between where the seller's at mentally and where the buyer's at, but it will happen over time, and pricing will probably not drop dramatically, mainly because inventory is still so low. But as inventory goes up, pricing will go down. How far it goes down, it will really depend on inflation and all these other ancillary factors that is really hard to, determine. Like, a war with Russia could change everything, but we don't have any way to know that, right? So realistically, if I'm being positive about the situation, I think that inflation will hopefully, we're peaking now, and that we're going to chill out through the rest of the winter, and by springtime, the Federal Reserve is likely to loosen up rates, but they may get worse before they get better. They're supposed to meet again in December, and they're already saying they may do another rate hike. But then by the time late spring, early summer comes around, interest rates start to return to a little bit more of a stable scenario and a little bit less than what they are now. And, things become a little bit more normalized in our market. If I'm being a pessimist, I'm thinking we're going to go through the midterms and into the next election cycle for the next presidential cycle. Inflation is going to crush us for all of next year, and we're not going to see interest rates come down until probably the following year in 2024. I don't really think that that's the case, but there are people out there saying that that's a possibility. So at the end of the day, it is what it is, and we got to figure out how to maneuver in a new market, because we're officially in the shift, so welcome to it. And I hope this was informative, and I'm sure we'll see you around. So take care.